Let's talk about the market today and this comeback. Ian Weiner joins us, member of Drexel Hamilton's advisory board. David Zervos still with us, chief market strategist at Jefferies. And Mike, I mean, it was a pretty broad-based game. The question is, how safe is it?
Yeah, just how trustworthy the move is. I mean, this market does have a habit of, once it gets a little bit of a hint of tension release, right, from the bond market or an all clear, you do get it back in a big chunk at once. So I do think the market has, as I was just mentioning, got itself back to this decision point where, you know, there was a little bit of an overshoot to the downside. You absolutely had a pretty sharp swing in sentiment to the negative side, a lot of hedging, a lot of downside positioning, which I think has gotten unwound a little bit. And I do think for a little while, we're probably going to trade along with bond yields and currencies and see if the macro story gives equities permission to build on this or not.
Ian, do you buy this rally?
Not really. I think you got to be selling into this rally, actually. My sense is, given what I've seen on TV and talking to investors, it's actually gotten a little bit laissez-faire about China. I think people have sort of dismissed the real threat that this is. So in that case, I'd rather be selling into rallies and taking some exposure off the table to prepare for, you know, the fact that the Chinese, if they decide to peg their currency a certain way, can swing our futures, you know, hundreds of points. So that makes me feel like I've got to take a little risk off the table here.
I mean, it brings up, David, the fundamental reason why we were here, why the 700-point plunge, China's currency, Chinese weakening, escalations of tensions. Has anything fundamentally changed that gives you confidence to buy into this rally?
I mean, they sort of stopped. They didn't go aggressively. It felt like there was a chance they could. But I would also point to one other thing that Rick mentioned in the bond report, which is the 2-10 yield curve is now as low as at its lowest level since 2007. We just broke, I think we were just under 11 was the previous low from a month or two ago, and now we're at 10. You got to watch it. It's not negative, but the bond market is not telling you everything's great. And we talked about it earlier in the show. For the amount that equities have come back toward the highs, the bond market sell-off has been really minimal. This bond yield story is low and staying low. And that's got to be a little bit, I mean, that can prop up valuations.
That means so many things. Yes, it can mean recessionary. It can mean more Fed cuts. It can mean the ECB and everybody else.
But the fact that it's an inversion, that it's inverting more, is if it was doing it with a steepener, I'd be happier with that story. But the fact that it's doing it with an inversion gives me a little bit of pause.